Hey everyone, and welcome back to the channel. In today's video, we're going to be having a look at the PE ratio, and more specifically, we're going to be looking at the limitations of the PE ratio. So why it can't always be used in order to determine whether or not a stock is cheap versus expensive, and what are some of the traps that beginner investors fall into when using the PE ratio to determine the value or whether or not a stock is at a price that they would be willing to pay. So that's what we're going to get into in today's video. Make sure you leave a like on the video if you do enjoy it, and I want you to let me know your thoughts down in the comment section below. But for now, guys, let's jump into it. So what is the PE ratio? And simply speaking, the PE ratio is a comparison between the price of a business and what it has earned in the past 12 months. Now, this is a great measure of comparing how much you're paying compared to what you're getting back as an owner. Because of course, when you buy into a business, you're paying that price, and you as a business owner, you get what those earnings are. And the PE ratio is just a nice way of cutting up the price in terms of per share, what you're going to be paying, and cutting up the earnings into earnings per share, and then comparing the two. And this works really well as a way of determining sort of your earnings yield and whether or not a stock is cheap or expensive if a company was to earn the exact same amount every single year. So if you could imagine a theoretical company that was earning $10 per share of earnings every single year in the past, and it was going to continue to do that every single year into the future. Now let's say that stock has a price of $100, then it would of course have a PE ratio of 100 divided by 10, which is a PE ratio of 10. And that also means that it would be, if you flip the equation and you put earnings above the price, you get the earnings yield, and that would be an earnings yield of 10%, which is a good return on investment. And since this company is going to is going to generate $10 of earnings every single year into infinity, because it's a theoretical company that just earns $10 every single year, then that means if you buy it at a 10 PE, then every single year from that point onward, you're going to earn a 10% earnings yield on the price that you initially paid. And in this circumstance, looking at a stock like this that doesn't really exist, but let's say there's a business that earns $10 every single year, then you would want to pay the lowest PE ratio that you could. Because if you could pay $50 per share and it was earning $10 every year, that would be a PE of 5. So if you could get it at a PE of 5, you're going to get a 20% earnings yield. So if you do 10 divided by 50, that's a 20% earnings yield. And in the same way, if you were to pay $200 per share for that $10 of earnings every single year, then you're paying a 20 PE, which is a higher one. And you wouldn't want to pay that higher PE because at a 20 PE, you're only getting a 5% earnings yield. So in this circumstance where the earnings are the exact same every single year, the PE ratio does a great job at telling us how much we're going to earn, and it also is a great way of, and the best way that we can use it, of course, in this circumstance, is to pay the lowest PE possible, because the lower PE that we pay, the lower price we're paying compared to what they're going to earn every single year over the next foreseeable future. However, that's just about where the usefulness of the PE ratio ends, because there are no companies out there that earn the exact same amount every single year into the foreseeable future. Most businesses, pretty much every single business out there operates in a business cycle. Now, some businesses are very defensive, and in that way, their business cycle generally moves with the economic cycle, which is where you're going through a 5 to 8 year period of expansion in the economy, and then you're going to have a 1 to 2 year contraction of the economy called a recession. So for some businesses, that's how their business cycle will operate. But for other businesses, their business cycle will be much shorter. Maybe it's 3 to 5 years that there's an expansion in the earnings of those companies, and then there's a contraction of the earnings of those companies. And for pretty much every business out there, their earnings are going to oscillate. They're going to go, they might trend upward or they might trend downward, but they're not going to go up in a straight line, or they're definitely not going to go across in a straight line. They're going to move up and down and down. So you might have earnings of a company that goes, say, $6 per share, then $10 per share, then $14 per share. That's the expansion. And then there's a contraction. It goes down to $8 per share, and then $8 per share again. And in this circumstance, the PE ratio over that time if the price of the stock was $100 every single year throughout that period, then the PE ratio is also going to fluctuate during that time. So if the price of the business was $100 every year through that time, then the PE ratio in each of those years would have been something like 15, 10, 7, 13, 13. So the PE ratio in that third year, where it earned $14 per share, was just 7. It was the lowest possible. So you would think that because it has a low PE, that is the best time to buy this business. But in fact, if you had bought at that time, looking at those 5 years, that would have been the worst time to buy it, because in the next 2 years, its earnings went down. Now, in the same way, you can see that in the first year, when they earned just $6 per share, their PE ratio was the highest out of all of those years. It was a 15. So under the traditional understanding of the PE ratio, you might think that you would want to, this would be the worst time to invest. However, you can see that over the next few years, it went on to earn $10 per share, $14, and then 8 and 8, which were both above that initial $6. So that would have been the best time to invest in this business. Now, in reality, none of these two examples are accurate, because you never have a company that has completely flat earnings, and you also never have a company that has a completely flat price. So for that reason, both the price and earnings fluctuate throughout the life of a stock, and for that reason, the PE ratio is just even more unpredictable. So that means that if there's a low PE stock, it could mean that it's cheap, but it also could mean that it's expensive, because if the earnings of that company are about to drop off, if the business cycle is about to tip over, then that low PE isn't an indication of a cheap stock. Because when those earnings drop off, the PE ratio is going to expand. And in the same way, if a stock has a high PE, it could indicate that it is an expensive stock, but it could also indicate that it's a cheap stock if the earnings of that company are about to explode. So if the earnings of a company are quite low, then its price might be quite high and it might have a high PE. But if those earnings are temporarily low and they're about to expand and they're about to go 5, 10x over the next 10 years, then that could indicate that the stock is actually, in fact, cheap. So the point I'm making here is that the PE ratio is just a picture of the past 12 months of earnings compared to the current price, and it really shouldn't be used in isolation as a good indication of business value and whether or not a stock is cheap versus expensive. So then how should we actually be comparing the earnings of a company to its current price? And I think that there is two things that we need to look at. The first is that we need to take an average of the earnings over the past 10 or 5 years. And the reason we need to do that is because we need to include the entire business cycle. Like that example we showed before, and like pretty much every business out there, earnings are going to expand and then they're going to contract for a little while before they continue expanding. Even in really great companies, there's going to be periods where their earnings are contracted simply because they'll have an outstanding year and then the next year is just too hard to compare against that. So to avoid accidentally looking at earnings that have been maybe 1 or 2 years of really, really solid earnings, but it's actually not a good reflection of the company's sort of average earnings, we want to take an average of the past 5 or 10 years of earnings to capture all of the movements in the business cycle, and then take an average of it to see what earnings we would have made on average throughout that period. And then we also want to take into account the growth of those earnings from business cycle to business cycle. So you can think of taking the average over the business cycle as being conservative, as being careful not to just judge a company on its latest earnings. But then we also want to balance that by being fair about how much a company could grow into the future. Because if a company has been growing from business cycle to business cycle at 5 to 10%, then we could safely assume, if the fundamentals are right and you understand the business and you can see that it's a possible realistic expansion that the company could have, then we would want to estimate that those earnings can grow at that 5 to 10% rate over the next business cycle. Now, an important component here is to make sure that you actually understand the business and its industry that of the specific stock that you're looking at, because as I said earlier, the business cycle for different businesses lasts different lengths, and there's different catalysts and different triggers that sort of show where it begins and where it ends, and you need to be able to identify this so that you can accurately take an average of the business cycle earnings, and then you can compare that to the average earnings from the previous business cycle to see how it has changed over those two cycles. A common mistake that many people make is that they just look at the growth of the earnings for the past 5 or 10 years without understanding where the business cycle ends or begins, and then they use that growth rate to continue to grow the earnings of the company into the future. So I want to give you an example, and I'm going to use Thor Industries. Now, if you want to see a great analysis on Thor Industries, then I suggest you check out Sven's latest video on it. I'll leave a link to it down in the description below, and he talks about how this company has been a value trap from its peak if you had done exactly what I'm going to explain in this video right now. So that's a really great video if you want to learn more about this sort of stuff. I'll leave it linked down in the description below. But essentially, if you had taken right now and averaged the growth of earnings for Thor Industries over the past 10 years, then you would have found that they grew their earnings at an average of 43% per year compounded. And that is an insane number. And of course, if you had used that to grow it into the future, you would have come up with an evaluation that is just sky high and just not realistic at all. And the reason that it's not realistic is because that 43% compounded growth is from the bottom earnings of the cycle all the way up to the top. But it doesn't include the fact that we're about to go over the top, or in Thor Industries' case, we are going over the top, and there's going to be a significant drop in earnings, probably somewhere between 70 and 80% over the next couple of years. So what you need to actually do is, first you need to understand the business so that you can work out where the beginning and the end of the cycle is, and you want to compare the average earnings in that cycle to the average earnings in the cycle before. And if you do that with Thor Industries, you would find that the latest 10-year average earnings was about $3.66, and the previous cycle was about $2.20. And that gives us a compounded annual growth rate over cycle to cycle of about 5%. So then what you could do is you could grow that $3.66 of the average earnings and grow it at 5% as a conservative assumption of where the average earnings for the next cycle could be. And if you did that, you would come up with an average earnings for the next 10 years of $6 per share, which would mean the company would likely conservatively return to you about $60 per share over the next 10 years in terms of earnings. And this is by far the best way in order to value a company. If you just look at a single year of earnings, you're not going to get enough of an understanding of how the earnings of a business will trend over the next 10 years while you hold the stock. Whereas if you take an average and you work out the growth that is realistic over the next 10 years, and you grow that earnings into the future, and you calculate how much cash you're going to get back, from this stock, then you can put a reasonable price on what you're willing to pay for that cash. So I hope you guys enjoyed this video, and if you did, of course, leave a like and let me know your thoughts down in the comment section below. If you want to see more videos like this, then make sure you hit subscribe and hit that notification bell so you don't miss out on any of the future notifications. But I hope you guys have a great day, and I'll see you in the next one.